Why would you ever pay more than $1, sometimes $2 or more to own $1 of Bitcoin? And the premise or the pitch has been these companies will compound your Bitcoin over time. So you might have paid $2 for $1 of Bitcoin, but in 10 years, maybe there's now, maybe you're now getting $2.50 of Bitcoin for what you previously paid $2 for. And the idea is that these companies are sophisticated at scale. They have better access to capital markets, and so they can raise money cheaply to purchase Bitcoin using creative structures. Saylor has really been the trailblazer here with pref equity, convertible bonds or convertible notes, and previously forms of secured lending. So he has about, at this stage, I'm going to get this number wrong, but I think it's about 5 layers of his capital structure. He has everything from Strife, Strike, to right down to common equity. But what he's done is he's been able to segment Strategy's balance sheet and capital structure to sell different products to different institutional investors. Probably the best known example was the convertible bonds, where they were effectively sold to convertible debt investors because they had a lower or rather a lower implied volatility than what they really did in the market. And so they looked really cheap to those players, and it gave Saylor a war chest to go out and buy more Bitcoin. So that's the traditional vehicle. And if I contrast it to what we are doing and what others in the DeFi space are doing, we're using a different kind of underlying mechanism to generate the yield or to generate the return. So I think the core difference, if you boil it down to it, is most of these companies as yet are not actually generating a yield on the underlying asset, which is their Bitcoin stockpile. They are instead tranching out their capital structure to generate returns for their investors, and the ultimate return just comes from the appreciation of Bitcoin or the volatility therein. Whereas for us, we've had to take it to a kind of a more fundamental level, which is we actually need to generate a return on the Bitcoin. And there's 4 ways you can do this, Pete. The 4 ways are: you can either lend it, and so you're taking counterparty risk. Somebody borrows your Bitcoin, does something with it, and pays you interest for the privilege. The other way you can do it is volatility trading. So you try and not time the market, but you're trying to effectively monetize the volatility of Bitcoin while still having the same overall number of Bitcoin. And then the other 2 ways are that you can stake it. And this is what we've done in partnership with CoreDAO. So we're effectively validating the core network. And to do this, we need Bitcoin and core tokens, and we generate a yield, which we show our clients in Bitcoin. And then the other way that you can do this is by selling covered calls, which is, in essence, you're giving up the upside of future appreciation of Bitcoin in exchange for generating a yield now by selling options. So I know that was kind of a lot to unpack, but the core essence is the treasury companies are effectively monetizing the capital appreciation of Bitcoin and using very sophisticated capital structure engineering, whereas we are trying to generate an underlying yield on that Bitcoin.
Right. So the difference here, I think, maybe simply is that the Bitcoin yield, that when you're talking about Bitcoin treasury companies, and the sort of yield that you would get from just having a service and customers sort of paying, whether for it's borrowing or lending, they're sort of paying some continued interest rate. These are not the same things. They're offering you, maybe as an end user, exposure to some sort of additional Bitcoin earnings, but they're actually coming from a different place, and they have different risks.
Yeah, that's absolutely right. So different risks. And in our case, what we're trying to do is we're offering more of one simplified product, which is in Maple's case, you lend us your Bitcoin, we stake it, and then we give you a yield back in Bitcoin. And what we do on the back end is we manage the staking operations and infrastructure, which isn't trivial, and then we hedge out the risks. So we mitigate the market risk and the counterparty risk. And so for you, it looks like a simple product. You lent us your Bitcoin, so it wasn't a taxable disposal. It's held in custodians, and then we give you back Bitcoin yield. We're not giving you back yield in points, other tokens. It just comes back in Bitcoin. And so a lot of OG Bitcoin holders and institutions have liked the product because they can also do it in native Bitcoin. They don't have to do complex, uh, interact with smart contracts or
Whereas, and
complex
maybe with the contrast to the treasury companies, you're putting the Bitcoin, you're buying the equity shares, right? So if you are putting Bitcoin into these companies, you're maybe even investing, you're likely doing that into some sort of conversion into dollars, and there's some tax implications with that, correct?
Yeah, I think if you were to subscribe for a fund in Bitcoin, often it's treated as a disposal, and so you will incur capital gains on that. I think it's definitely worth noting, one of the appeals of becoming I'll call it a private side investor in one of these Bitcoin treasury companies, is that if you do the pipe, or if you do uh, the converts, some other subscription for it, often what you're able to do is subscribe in Bitcoin. This is what Tether's done with 21. This is what others have done with the more recent ETH vehicles. And so what you're doing there is you're getting the optionality that in the near term, it's kind of unlikely that you're going to trade at a massive discount to the value of your Bitcoin. So effectively, what you've been able to do is take, the one Bitcoin that you had, and effectively get a markup on it of, two, three, sometimes a higher multiple on that. So you've been able to um, you've been able to effectively turn what was $1 of Bitcoin into $3 of assets there. And I think that's a big appeal from a tax efficiency perspective.